What's happening, everybody? How's everybody doing this afternoon? Joe Barletta here with you on your Milestone Real Estate Coaching call. For those of you members who are with us in the art and science of real estate investing, welcome as well. Today, I got a special guest, Ted Lanzaro, who is a longtime associate of mine. He is a highly sought after CPA. He's a real estate broker, a speaker, and author of the Tax Smart Landlord. And before I bring Ted on, which I'm going to be doing here very shortly, I want to make a point to you guys about the power of strategic relationships. And I'm going to demonstrate this with a quick story for you that happened to me this week in my own company. So this week, twice, we had two very substantial challenges. I don't like to use the word problems, but two very significant challenges. One was a deal-related issue, and the other one was a marketing issue that we had been affected with a major change in one of our advertising strategies that had a significant impact on our traffic for our leads. Now, in both situations, when these challenges came up, I took a step back, looked at the situation, and I thought to myself, okay, what is it that I know here right now? What do I think we should do? What do I think needs to be done here? And then I asked myself, who do I know that can help me solve this challenge? Right? So immediately I thought of, well, what resources do I have that could make this challenge go away? All right. Now, who do I know that has the answer or the solution or the insight? And that is something you constantly want to be asking yourself. Okay. Now, both situations for me involved me picking up the phone and reaching out to my network. And guess what? You know what happened? I had the clarity, the direction, and the confidence how to proceed, okay? There was no stress involved. There was no procrastination, no indecision. Instead, I got a very clear action plan on how to move forward, okay? And that is what we're going to be talking about here today with Ted. He is the type of person, as real estate investors, you want to have on your team to advise you with tax strategies. Okay, now Ted understands the tax code. He understands, more importantly, what it's like from a real estate investor standpoint as well. So those are two very unique skill sets to have. And that's not something that you're always going to be able to find in an accountant. So Ted is an author of the Tax Smart Landlord, which we're going to be discussing here today. And be sure to stick around because I'm going to give you guys the link to download a copy of the book for free, which Ted has arranged for us, which is really cool and generous of him. Basically, I'm just going to be asking Ted some questions about the book. And as we go along, you can type your questions in the chat box. Anything that comes up, we'll set aside some time at the end of the call for some open Q&A as well. Just a little disclaimer here today. Obviously, this call, what we're going to be discussing, this is for informational purposes only. Neither I nor Ted has the insight into your unique situation or business. So before you go ahead and implement any of these strategies, be sure to discuss it with someone who is familiar with that, your unique situation. So with that being said, let's get ready to take some notes. I know I will. And I'm going to bring Ted on here and let's see. We'll get rocking and rolling. Let me see if I can find you here. Ted. Are you there, Ted?
I'm here.
All right, buddy. I'm going to ask you to start your video as well. If you can turn your camera on. There you are, buddy. What's going on, pal?
How's you guys? How are you?
Excellent. It's great to be on call with you.
Yeah, thank you. It's great to be here.
Yeah, thanks. Thanks for doing the call with us. So got your book here, The Tax Smart Landlord. Tell me a little bit about this, bud.
Well, this is, I wrote this book back in 2016 because I really felt there was a need for real estate investors to have a common sense, plain English guide to tax strategy for real estate investors. Most of the stuff that I read online and other people's materials were all written like you had to be like a lawyer to understand all of the information. So right. I was like, this needs to be simplified. And so I basically took the same strategies and advice that I was using for my clients, and I put it in a nice kind of Q&A kind of format so that it was basically easy to understand. And I like those. You ever read those Don't Sweat the Small Stuff books?
Yep,
right?
yep.
They're all like, every chapter is like, 2 pages or 3 pages.
Mm-hmm.
And so they're easy to read. The chapters are
Right.
easy to read. So I kind of formatted it that way so that things were easy to read and it could be used. Hey, I've got this particular situation. I don't have to read the whole book. I can just go to chapter 20.
Yeah, that's awesome. It's very pertinent. And like you said, when some people start hearing about tax code and all that stuff, the information that is available, a lot of times people's eyeballs start to roll into the back of their head, right? So that's what I really like about this book. It's very straightforward, very easy to understand, which I think you did a great job with and making it very actionable. And like you said, if you just want one specific strategy or something that you need to brush up on, you can go right to it without having to, comb through tons and tons of information. With that being said, we get a lot of people in my group that I work with one-on-one, and we've got investors from, everything from very beginner to very experienced. What advice would you give to an investor who's just getting started, ground zero? Any specific tips that you would give on how to get started on the right foot when they're starting their real estate investing business?
Yeah, I think a lot of it starts with the idea that you want to be organized and you want to be a good record keeper.
Mm-hmm.
So whenever I do a tax talk, an interview like this, I tell people you want to have good record keeping. Mm-hmm. and be organized, because you wouldn't build, because it's the foundation for all of the tax strategies that we'll talk about later. It's very difficult to implement tax strategies if you don't have good records, don't have the ability to tell me, yes, I made this amount of money on that flip, or right, my cash flow on this rental is X amount of dollars,
So what you're saying is going into the shoebox for the receipts and all the, just pulling out a big pile and dumping it on your desk is not a good move, not a good strategy?
Probably not the greatest move, right? Because think about it from this standpoint. You're going to miss stuff. There's stuff that didn't make it into that pile, mm-hmm, right? And so the easiest thing to do with that is to treat what you're doing like a business, right? And so a business has a business bank account. So if you set up a business bank account, for example, and then you get yourself a debit card and run all of the activity of your business, either pay it with your debit card, or you use a check to pay the bill, mm-hmm, because then everything, the worst case scenario is, even if you don't do any bookkeeping throughout the year, everything is on your bank statements, mm-hmm, right? Mm-hmm. And that prevents you from, what a lot of investors, including myself, have done in the past, which is run into Home Depot, buy a couple of cans of paint for something, pay in cash and walk out, and then the receipts go on. You probably lost. Mm-hmm. You probably lost that deduction because you can't find the receipt. You're not going to remember that a year later, right? So if you approach everything from the standpoint that I'm going to be a good record keeper, then that's where you're going to get the maximum ability to deduct everything, because you're tracking it all. Mm-hmm. If you're doing it the other way, if you're doing it the receipt, I guarantee you're leaving money on the table if you're just putting things in a shoebox. I guarantee you.
Yeah. So could you give me an example of like how, what a good filing system would be set up for, let's just use one particular rental property. Like, what would you like to see as far as a good filing system, or for your own example, like, what do you do?
Right. I would have a file box, right? Mm-hmm. And when I say file box, I happen to use the non-technical, I'm not a techie. So, mm-hmm, I keep literally a paper file box, and I have in there utilities, taxes, all the different leases, all of the different things that you're going to have on a rental property, right?
Subfolder within the folders.
So I have literally a box, a plastic box with those green, mm-hmm, hanging folders.
Yep.
Each one has a tab on it, mm-hmm, that says, and this is the old school way to do it, by the way. You can do the exact same thing inside your computer using, mm-hmm, computerized folders and tabs, right? And then I just, whenever I pay a bill, I put it in the appropriate folder for that, utility, taxes, whatever. Mm-hmm. Now, I'm also using I use QuickBooks, but you can also use a computerized spreadsheet if you'd like. You could use, in the old days, they used to use green columned paper,
Mm-hmm, mm-hmm.
and you would write on the top of each, there were 13 columns on the paper, and you'd write taxes, utilities, whatever, and you just write the number in January and
Right.
whatever your bill was.
Yep.
In QuickBooks, there's a computerized way to do it. You enter the check, right?
Mm-hmm.
If you're running everything through one bank account, then no matter how you do the bookkeeping, or if you never even do bookkeeping, all of your information is there. And then the worst possible scenario is you have to hire somebody, a bookkeeper, to organize it for you.
Right.
Whether it be in an Excel spreadsheet, QuickBooks, or just on paper. And
Right.
I tell people, use the system you're most comfortable with.
I agree. Yeah. Yeah. The best system is the one that you use and the one that's right for you. Right.
Right. Exactly. It's going to be the one you use.
Yeah.
Right. So I would rather have a good spreadsheet than bad QuickBooks.
Mm-hmm. Right. Yeah. And I can attest to that, because when I first got started, I really didn't know, one end from the other as far as operating QuickBooks. And that was the first hire that I had. I mean, my bookkeeper was a lifesaver for me, because it was just a disaster. That was the last thing that I wanted to be doing. I didn't know heads or tails of how to get in there. I just, now to this day, she comes in, she enters everything for me. I sign checks. She runs reports for me. It's all there. It's itemized. It's organized. Boom, done. Get that off your plate. If that is not the place that you want to be as an investor, if that is not your gig, it's just, for me, it was just a complete disaster. So hire somebody 100% if it means, spending a little bit out of your budget, but having that organized is going to save you a lot of time and money on the back end when it comes time to file your taxes, so you can take advantage of all the deductions, right?
Yeah, that's exactly right. I think whatever you spend on bookkeeping is an investment in tax savings.
Yeah, yeah. So what about now as a new investor, right? Just getting started, and you had mentioned opening a dedicated bank account and having a debit card. A lot of times new investors, they're pulling money from everywhere. They're utilizing convenience checks on a credit card that comes in. Basically, they end up, what's referred to as commingling, right? They,
Right.
how can they avoid doing that? Can you just define what commingling is? And then secondly, how can that best be avoided?
Right. Well, typically commingling refers to either paying business bills out of your personal account or paying personal bills out of your business account, or vice versa, right? So that's, you want to avoid that, right? So now let's say you are using convenience checks, right? Well, what I'm going to do is I'm not going to write that convenience check directly to my contractor, for example, or so what I'm going to do is I'm going to write that convenience check to my company, and I'm going to put that check into my company, and then I have the money. I know I put the money in, right? Now I know I owe the credit card company that money, and also I'm going to I'm going to write the checks or use the money from my debit card to pay the bills.
Okay.
Right? I'm not going to, so that way I can track it. It's the same thing as using, so inside your company, you can have 10 different credit cards that you're using, right?
Yep.
But pay the bill out of your checking account that you've set up, and you want to try to have dedicated credit cards if you can.
Right.
You don't. If you should take some credit cards and say, these credit cards are just for my business, and they're not. I'm not going to do personal things with them. I'm just going to try to the extent that you can. It's not going to be a perfect scenario, but if you're paying the bills out of the checking account, then you know exactly what you paid for.
Right, exactly. So you got a very clean trail there. Would that be kind of structured as like the company would then owe you, like would it be a personal loan from you to your company at that point? Would that how that would be structured?
Or it could be a loan from the credit card company to your company.
Got it. Okay. So
depending on how you look, I mean, it's the same thing basically, because the credit card company is going to get paid back.
Okay. So in order to avoid commingling of funds, anytime you get like those personal convenience checks or opportunities, put it into the business account first before you go and pay directly to your vendor or your contractor.
Right. Exactly. That would be considered a loan, you're loaning the company money from your purchase.
Got it. Okay. Now, what about as far as education costs, like going to seminars and conference and books and that type of stuff? Would those be considered itemized deductions that you could use for your business? Is that something, a lot of investors, we're going to seminars and conferences. Is that something that you could use as a deduction?
Yeah. The thing you have to be cognizant of is that in order to deduct your education, okay, and I call it business coaching.
Mm-hmm.
I don't like to use the term education,
Mm-hmm.
because you can't go and deduct the cost of your college education against your business. Typically, that's against the rules.
Okay.
So I call business coaching. Okay,
Mm-hmm.
business coaching is a legal deductible expense, right? So now what I'm going to do is I'm going to deduct that, but I've got to make sure that I've made some money, because if I've made some money, so what a lot of new investors come up with is they've paid for coaching, but they haven't done their first deal yet, right?
Mm-hmm. Mm-hmm.
They have their company set up and they paid for the coaching. Well, what happens with that is that's called a startup cost. Okay, so any dollars you spend, whether it be for education or marketing or whatever, that before you make your first dollar, okay,
Mm-hmm.
it's considered startup costs, and you're only allowed to deduct the first $5,000 you spend
Okay.
as startup costs, and then the rest of the startup costs that you accumulate prior to making your first dollar, those get amortized over 15 years. So what you want to try to do is well, the easy solution to that is make money fast, right?
Yeah, right. Of course. That's the whole point, right?
Yeah, right. So if you can get your first deal in fast, right, then you're set. The other thing that I do typically is I'll break up the coaching, like when people spend, reasonable, pretty good sized chunks of money sometimes on coaching, and the program is over a period of, say, a year or two, I'll break it up. If it's 2 years, I'll bust it into half, so that the following year, I'll make a note in my file, so that the following year, maybe you made some money and we'll deduct that half in the second year, because really the even though you paid it in year one, you use the expense over a couple of years with the continuous coaching.
Got it. Okay. Now, do me a favor. Can you explain to us at what point, there's this classification as being a real estate professional. At what point does one be considered a real estate professional, and why would you want to be considered a real estate professional as an investor?
Right. So there's three categories of investors. The first one is passive.
Mm-hmm.
A passive investor just is like a silent partner in a limited partnership, or somebody who's not managing their own properties. They buy a rental property, they own it, but they have a management company taking care of it for them. They don't get involved in that. In that scenario, you're not allowed to deduct your rental losses. You can only go to zero. Okay, so you don't have to report it. You can get your income down to zero, but you can't actually lose money and deduct it against your other income, your earned income, your business
W-2,
income, your salary, your W-2.
Mm-hmm.
Now, if you're a real estate, if you're what's called an active investor, okay, then subject to certain income limitations, you can deduct up to $25,000 of rental losses against your earned income.
Mm-hmm.
And that's really good. But you have to be actively managing the properties. That means you collect the rents, you pay the bills, you go and find the tenants, and you can use real contractors and stuff, but you're the person who's directing the activity of the people.
Okay.
If you do that, you can deduct up to $25,000 of rental losses against your ordinary income. Rental losses, by the way, typically come in the form of depreciation, and not in the form of you actually losing money.
Right.
So you want to have a positive cash flow property, let's say it makes $5,000 a year, but you've got $10,000 of depreciation. So you've actually got a $5,000 taxable loss,
mm-hmm.
while you still have $5,000 in your bank account, right? So that's the whole idea of investing in rental properties is, hey, I've got money in my bank, but I don't have to pay tax on it because I'm using the depreciation to offset it. That's why they say real estate is the last great tax shelter.
Mm-hmm. Mm-hmm.
Sheltering money means. As a
Right.
real estate professional, you have to have 750 hours or more documented that you're doing some sort of real estate activity. Okay,
Mm-hmm.
that could be, hey, I'm a broker, but I also own some rental properties,
Mm-hmm.
or I'm a developer and I own some rental properties, or I'm a flipper and I own some rental properties, or I just run a whole bunch of rental properties. And
Yeah.
here are my hours. I've documented my 750, and it's more than half of anything else I do. Okay. So if I have a separate company, let's say I have an accounting firm, right? If I work 1,000 hours in my accounting firm, I have to work 1,001 hours on my rental business, because it has to be more than 750 and more than half of what I actually do.
Okay.
So people come in and people come into my office and they say, well, I want to be a real estate professional, but I work a full-time job.
Mm-hmm.
Work 40 hours a week, 52 weeks a
Right.
year, 2,080 hours, right?
Yep.
Well, that would mean you'd have to work 2,081 hours in your rental business. So unless you're a working maniac, right?
Elon Musk. You don't need to sleep.
Right? You're going to have a hard time. You're going to have a hard time qualifying. But if you do that and you're in the real estate business, well, that's just part of the business. Now, the advantage to that is unlimited deductibility on your rental properties.
Mm-hmm.
So whatever you lose, in the form of depreciation, you can offset against any of your other earned income. So I have real estate broker clients who own a lot of rental properties, who maybe they make $100,000 a year brokering properties, but the depreciation on their rentals is maybe $50,000. So
Mm-hmm.
now they only have to pay taxes on $50,000 of their earned income.
Mm-hmm.
Right? They're using their rental losses to offset that.
Yeah.
So it's a really nice advantage for people that are in the real estate business.
Right. Now, you had just mentioned depreciation. And by the way, for those of you guys who are just joining us, we got Ted Lanzaro on today, the author of the Tax Smart Landlord. I'm going to be, for you guys, if you guys want to grab a copy, a free digital version of this book, you can go to joebarletta.com/taxsmart, and we'll make sure that you guys get the link in the chat box here very shortly. Also, what I wanted to mention, Ted, you had just talked about depreciation. Can you tell us a little bit about how that works for someone who's not familiar with that or just getting started?
Right. So think about it from this. Standpoint. Depreciation is essentially an allocation of the cost of the rental property over what the IRS determines the useful life of the property is. Mm-hmm. So for residential rental properties, the IRS's useful life is 27 and a half years. Okay, so if you own a two-family house or a 100-family apartment building, it's 27 and a half year depreciation on the cost of the building. Okay, mm-hmm. Now, on a commercial property, let's say a shopping center or an office building, it's 39 years. Okay, so what happens is, let's say we go out and we buy a simple example would be, we go out and we buy a two-family house and it costs $275,000. Okay, and I use 275 because it's easily divided by 27.5. Right.
Always a method.
So now we have $10,000 a year of depreciation. Right. So let's say we have this property and it makes $10,000 of net income. Okay, so I have $10,000 of cash flow in the bank. Mm-hmm. Now I offset. I take the depreciation deduction, which is $10,000, and my taxable income is zero. Okay, I pay zero tax on that $10,000 I earn. I still have the $10,000 in the bank. I'm not going to pay the taxes because I've used the depreciation, which is an allocation of the purchase price.
Got it. Now, in your book, you talk about accelerating depreciation. Okay, when is that appropriate, and how does that work?
Okay, so accelerated depreciation means that there are certain components within a house, okay, that don't have to be depreciated over 27 and a half or 39 years. They can be depreciated over either 5 years or 15 years, okay? I'll give you a couple examples. Anything that I can walk into, let's say I have a two-family house, the same two-family house we're talking about, and I walk into that house, anything that I can unplug, unscrew, and walk away with is actually considered 5-year property by the IRS. So those typical 5-year property would be the appliances, okay, the sink, the cabinets, the light fixtures, shelving, all the stuff you might find in the closet. Bathroom would be the vanity, the mirror, the toilet, right? Anything that I can literally unscrew and walk away with, all of that is 5-year property. Okay. 15-year property is all the stuff on the outside of the house that's considered a land improvement. Okay. Like the cost of your driveway. Okay. The cost of the walkway from the driveway to the door or doors. Okay. Retaining walls, landscaping, okay, all
Deck,
of those
patio,
fencing, right, patio, all considered 15-year property. So typically what happens is when somebody takes their buy a rental property, they go to their CPA's office, the CPA will say, okay, you paid $275,000 for this house. We're going to put 80% as the cost of the building. We'll depreciate that over 27 and a half years. The other 20% will make land, and land does not get depreciated. Okay, that's the wrong way to do it. Okay, right. Now, if I'm passive investor, or for whatever reason I'm phased out of being able to take any kind of rental losses, maybe I'm an active investor, but I make too much money to take rental losses, because as an active investor, you do get phased out of your ability to take rental losses at $150,000 of adjusted gross income. So if I have a lot of people, if they have a really good job, might make $200,000 at their W-2 job, right? Well, they for all intents and purposes, even if they're actively managing their properties, are passive investors because they get phased out of being able to take losses, right? So I wouldn't go and do this breakdown that I'm going to tell you about for those people. But for the people who can take the losses, I'm going to do the accelerated depreciation. So I'm going to walk into that 2-family house and I'm going to count up all of the various 5-year assets and all of the 15-year assets, and I'm going to value them. Okay. And the book has the list.
Right.
So it shows you the breakdown and how to do it.
Which is very cool.
And you say, okay, I've got 5 appliances. If I went to Home Depot and I bought these appliances, they would cost me $3,000 new. Okay. Now let's say they're in average condition, then I would use 50% of the new cost. If they're in really good condition, maybe I'd use 75% of the new cost. If they're brand new, I use the whole new cost. And if they're basically throwaways, then I'm going to use maybe 10% of the real cost.
Got it.
Of the new cost. But I'm gonna do an allocation of all of that stuff, right? And I'm going to write it all down. I'm going to give it a price, and then I'm going to calculate a total of the 5-year and a total of the 15-year, because I don't want to do the 80-20 rule that most accountants do. What I want to do is first, I want to take my purchase price to 75, and then let's say I have $20,000 worth of those 5-year assets. Well, I'm going to show the $20,000. Now my cost is $255. Let's say I have $10,000 of land improvements. Now my cost is $245. Now I go and do the 80-20 split. Okay, because now I've allocated my 5 and 15-year. I've got a lower 80%. So, and then I've also got a lower 20% for the land, because I want to allocate as little to land as I possibly can. Right. So that's how you go about doing it. That's the right way to break out the original cost basis on a rental property, so you're able to take rental losses.
Got it. That's huge. Because I think a lot of accountants will, for lack of a better term, take the lazy way out and just attach that 80-20 principle to it right from the very beginning without doing that cost segregation. Am I correct?
Yeah, exactly. I would say 90%.
Yeah. Okay.
90% of them do it.
Right. So that's something that you guys want to be aware of when you're talking to your accountants, making sure. Again, if you guys are just joining us, you can get a copy of Ted's book at joebarletta.com/Tax Smart. If you guys have any questions, type them in the chat box as we're going along here. We'll be sure to bringing to Ted's attention. He'll be helping us out as we go along here. Ted, what about investing within your IRAs? I think this is a very beneficial thing to cover and explain how investing within your IRA works and kind of cover some of the do's and don'ts of how some of those transactions can go.
Okay. So I love investing in your IRA.
Mm-hmm.
Okay? So you can, if you have money in a retirement plan, individual retirement plan, then you can convert it to self-directed, okay, which means you take it out of the traditional brokerage model and you put it into a self-directed retirement plan.
Right.
And now, basically, the self-directed company, basically, you normally would set up an LLC for that, right?
Mm-hmm.
And your IRA owns your LLC, and you get a checkbook with access to your money, and you can go out and you can buy a property.
Mm-hmm.
You can buy a property with debt also if you use non-recourse debt. Okay? So now let's say I have $275,000, and this will be a recurring theme, $275,000 in my IRA, or maybe I have $50,000 in my IRA,
mm-hmm.
but I'm going to go in, I'm going to get a loan, and I'm going to buy this property in my IRA. Now, my IRA owns the property.
Mm-hmm.
Here's the good thing about that. One, I don't ever have to pay taxes on any of the income, okay, until I withdraw it. So if it's a traditional IRA that I'm using, then I got a deduction on the money when I put it in. I can buy assets with it like a rental property, and the rental income that I put back in there, the net cash flow that I put back every year, is going to be my growth, just like I would have growth on any other investment. And then when I get to retirement age and I start withdrawing that money out, that's when I actually have to pay tax on that money, right?
Yep.
So I get the growth tax-free during the period of time that it's growing. And that
mm-hmm.
includes the appreciation on the property.
Mm-hmm.
So I sell that rental property and I put all the money back into my IRA. I don't have any capital gains tax, right? So I can literally build a portfolio of properties that I run for 10, 15, 20 years, sell them all, and never pay the tax on the money until I withdraw the dollars.
Mm-hmm.
So I have clients that are doing this. They're flipping properties inside their IRA.
Yeah, that was the next question I was going to ask. As far as can you wholesale, and rehab quick turn type strategies within the IRA?
Right. You can flip.
Mm-hmm.
Now, wholesaling,
mm-hmm.
you'd basically be making an IRA contribution at that point because that's considered earned income.
Mm-hmm.
But when you buy and hold, or buy, fix and hold, or buy, fix and sell,
mm-hmm. Mm-hmm.
okay, all of those are activities that the income stays inside your retirement plan. You're not taking the money out. You're not using it to pay your bills.
Mm-hmm.
Whatever profit you make goes right back into the IRA.
Mm-hmm.
Those are all in things you can do inside your IRA. Now, if you use a Roth IRA, okay, so the difference between a traditional IRA and a Roth IRA is, in a traditional IRA, you deducted the money when you put it in, and you have to pay taxes on the money coming out.
Mm-hmm.
In a Roth IRA, you put the money in after tax, okay? So you don't get a tax deduction up front, but you don't pay taxes on the money coming out, ever, okay? So if you were, let's say, for example, you had some money in a traditional IRA, you could convert it to a Roth IRA, pay the tax on, let's say it's $100,000 in a traditional IRA.
Mm-hmm.
So you say, okay, 2019, Ted, I'm gonna convert my money, I'm gonna pay the tax on the $100,000.
Mm-hmm.
Now I can self-direct as a Roth.
Mm-hmm.
Now, every dollar of growth that I make on that 100, I never pay taxes on. So if I turn that 100 into $1 million by properties, right, over 5-10 years, right, I never have to pay a dime on that money when I take it out.
Mm-hmm. Yeah.
So
I think you guys can see the power in that, right? I don't think
it's a great strategy, right? So now I don't have to worry about paying capital gains. I don't have to worry about. So what happens is your money grows faster. Mm-hmm. Now, every rose has a thorn, right?
Of course. Right.
So if you're, so remember at the beginning of the call, we were talking about record keeping and being a good record keeper, right?
Yes.
Well, this IRA strategy absolutely has to be done only by people who are good record keepers, okay? Because you better know how much real money you made, and in order to do that, you have to have a good record in order to put that money back into the IRA, right? Okay, so I tell people, great strategy, but it's got to be based on the fact that you're going to be very responsible about your record keeping, because if you don't put the money back in, or you don't have any idea what to put back in because you don't even know what the property made, right?
Yeah.
Well, then you're going to end up blowing this whole thing up, and you're going to be subject to some pretty serious penalties.
Yeah.
So you want to keep that in mind. The other thing that you have to keep in mind is that there's rules about self-dealing. Okay, so when you're if you're a rehabber and you buy a property to rehab in your IRA, you can't do any of the work.
Yeah.
Okay? Because you do self-dealing. If you're a real estate broker and you invest in your IRA, okay, you can't take the commission when you sell the property. I wouldn't even recommend listing the property. I'd have somebody else list it.
Yeah.
And pay the commission.
Right.
So there's a whole bunch. You can't buy a property from your wife or your brother or your mother. You know, there's rules on
arm's length, right? Arm's length transactions.
Right, exactly. So you just have to be, you got to know the rules, basically.
Right. And this is where having someone who's very familiar with this stuff on your team that you guys want to be looking, whether it's Ted or someone out there, make sure that you do, you know, because like I said, the power of relationships and solving these problems is really what gets you to that next level. That's great information, Ted. You know, what would you say are some of, like, now there's specific companies like these self-directed companies that exist out there. Anything that we should look to, or like I have a company that I've worked with, Equity Trust, that is the custodian for my self-directed IRA. What are some of the things that we should be looking at when we're talking to, you know, a company that does self-directed retirement plans? Any insight on that?
Yeah, most of the time, okay, they're going to defer. If you call them with a tax question or you call them with a setup question, they're going to defer to your CPA. They're going to say, you know what, call your accountant and ask them this question. Now, so as far as I would just evaluate, I would evaluate the company. Do I feel comfortable with this company? Just like I would do due diligence on any company, right?
Sure. Yep.
Do I know other people who are using them? You know, people don't, you wouldn't go out, you know, most people don't even make dinner reservations these days without
researching
reviews, right?
Right.
So, you know, do your due diligence, you know, don't just park your money.
Common sense stuff,
you know, right? You know, you got to make sure that they're reputable and, you know, maybe you know some other people.
Right. And another thing that I wanted to, if you could shed some light on, pretty much a lot of times you have to file like a separate tax return for the IRA at that point once it's self-directed, right? A 990T, is that how it works? Like you got the UBIT that you're responsible for, and
typically your custodian, you're typically in a regular plan, not a self-directed plan. In a regular plan, you would have your custodian would file the forms for you because you're not doing anything that would generate what's called UBIT, unrelated business income tax, right?
Yep.
So now, in a scenario where you have a traditional IRA and let's say you're doing a flip, but you borrowed money right, to do it. Well, now and let's say it was 50%. You put 50% of your own money in and 50% of a loan.
Yep. Non-recourse. Yep.
Right?
Non-recourse loan.
Now, 50% of the income that you make on that house. So if you made $20,000 on the sale of that house, $10,000 of the income, the 50% that relates to the loan portion, is going to be subject to what's called UBIT, unrelated business income tax. And when you go to file that tax return, you have to pay that UBIT tax. Right. Now, the way a lot of people use self-directed 401ks now, because The difference between the self-directed IRA and the self-directed 401k is that the self-directed 401k is not subject to UBIT.
Mm-hmm.
Okay, so that's a good strategy if you're maybe you own a business and you have a 401k of your own business that you're funding, right?
Mm-hmm.
Or you're moving your money from your existing work 401k, instead of moving it to an IRA, move it to another 401k.
Mm-hmm.
And that'll allow you to avoid that. If that's what you're going to do, if you're going to borrow money to do rehabs, or borrow money to buy rental properties, then you have to keep in mind that you'll have that UBIT situation on an individual retirement account IRA, but you won't have that tax when you use a 401k.
Got it. Got it. Guys, just another heads up. If you guys have questions for Ted, type them in the chat box here. He'll be happy to shed some light for you. Let's talk about 1031 exchanges for a minute. Can you explain what exactly a 1031 exchange is and how that works?
Yeah, a 1031 exchange is a tax strategy that we use when we sell properties. And typically what you're doing is you're going to, so the basics, a lot more complicated than this, but the basics are, I'm going to sell my property, okay, and I'm going to purchase a property of equal or greater value using all of the funds that I received from the sale of the first property, and I'm going to do that within certain time limits, okay? And if I do that correctly, then I'm able to defer the capital gain on the property that I sold. So it's a great strategy for deferring capital gains. And I'll tell you a quick story.
Mm-hmm.
I have a client who had, over the course of 10 or 15 years, built up a sizable portfolio of small properties, 2-family here, or 3-family here. He bought a small storage unit, had a bunch of small properties. At some point, he decided, you know what? I'm tired of managing all of these small properties. So he sold them all in one fell swoop to another investor who wanted to buy them, right?
Mm-hmm.
So he paid, I think, about $1 million in total for all these properties. This goes back a little ways.
Yep.
So he had, he sold them for $1.5 million. So he had a $500,000 or plus capital gain that he was going to have to deal with.
Mm-hmm.
So what he did was, instead of paying the taxes, he went and he bought a shopping center, okay, on a main road in the town that we lived in. And it was a little run down. He got a good deal on it. And then he went around, and over the course of 2 years, he fixed it up and he put some new tenants in it, right? And about that time, he was at a time where real estate prices were going up. And he got an offer for, he had bought it for like $2 million. And he got an offer for $4 million for the property, right? Yeah. So now he's got a $2 million capital gain on the original purchase, plus the $500,000 that he deferred on the first. So if he decided to pay the taxes then, he would owe taxes on $2.5 million of capital gain. 500 on the first sale, 2 million on the second sale. But he didn't pay the taxes on that. What he did was, he went and he bought, he didn't want to manage properties anymore, so he went and he bought some passive income properties. He bought 6 auto zones in Texas. And when I say auto zones, he didn't buy the actual store. He bought the land that the AutoZone building, the land in the building that the AutoZones run their retail operation on. Right? Now, he was the landlord for AutoZone. High credit client, right? Triple net lease, which means that he doesn't have to do anything, basically. They're paying insurance, taxes, the repairs, everything. So now all he does is get a check every month of the net income from those properties, right? Eventually retired. He's never paid a dime in capital gains, right? And all he has to do is pay the taxes on his rental income, which he now lives off of and does nothing.
Nice.
Okay? Now it's a long-term strategy, right? So it took him probably close to 10 years to accumulate the first group of properties, and then another 4 or 5 years to position himself. And he Was he fortunate that he did this all in a rising real estate market?
Both the right market
Absolutely,
cycle.
right?
Yeah.
But if he hadn't done the legwork to start with, he would never have been in the position to get where. So it takes you a long time to build a little wealth, but then a very short time to take it from $1 million to basically like $5 or $6 million.
Right. Yeah, that makes a lot of sense. Now, let's talk about, because in your book, you talk about, not selling, but passing it on. If this guy's, he's retirement age and he's talking about some estate planning, maybe he's thinking about passing it on to his heirs. Does he sell those properties? Like, what is the best strategy at that point? Like,
so here's a guy who has like he has about $5 million of property, right? But the reality of it is that he has a cost basis of like $500,000. So he's got a lot of unrealized gain right now.
Yeah.
What the IRS says is, when I die, okay, in his case, when he dies, everything he owns will get what's called marked to market. So whatever the fair market value of his properties, these 6 auto zones in Texas, whatever the fair market value of those properties are at the time that he passes away, they become his cost basis. All right. So now he's a really nice guy. He really liked me. I was a CPA for a long time. So in his will, he's going to leave me properties. Right.
Yeah.
Okay. So my cost basis when I get those properties, or maybe he gives them to his son, Well, let's say the son's cost basis when he gets those properties is going to be whatever the value of those properties are at the time the guy died. So let's say the value of the properties are $5 million, right? Well, now that whole capital gain, all that unrealized gain that he deferred his entire life, all of that goes away.
Yeah.
And now I'm the son. I get these properties at a $5 million cost base. I turn around, I sell them for $5 million. I don't have to pay a dime in taxes.
Yeah.
Okay. And now the estate tax laws are written in such a way now that there's not even any estate tax, federal estate tax. I'm at $5 million, right? And it's a lot higher. The only problem you might run into is like in the state of Connecticut, there's actually an estate tax in the state of Connecticut, which I believe is 2 point something million, anything over 2 point something million.
Right.
You end up paying the estate tax on. But in that scenario, there would be almost no tax due on the sale of that. There would be no tax due on the sale of that property. He basically went from a small portfolio, built a whole bunch of wealth, and then never paid a dime on the appreciation of the property.
Yeah, it's amazing when the options that you have when you know what it is available, or you have someone on your team, someone like Ted, that can guide you in that how to navigate those tax liabilities. So let's see. We got a question from Phil here, Ted. He says, what is the best entity to set up if doing rehabs and want to establish rental portfolio? He's currently a W-2 income earner going into business and getting a solo 401k set up. So what is the best entity to set up if he's going to be doing rehabs and he wants to establish a rental portfolio?
So normally I would say use an S Corp to run your rehab business, and use LLCs, one or more, to run your rental business. So I would keep them as 2 separate businesses. And the reason is each has a unique set of risks that you don't want to expose one to the other. Okay. So the other thing about using the S Corp for your rehab business is that you can avoid the self-employment tax that you would have running a business in an LLC. With that being said, every person has a different scenario.
Right.
So there's no one size fits all. And I'll give you an example. If because self-employment tax is subject to a limit on Social Security limit, and I believe the limit this year is like $138,000 of earned income on your W-2, and then you stop paying self-employment tax. So if I have a W-2 job where I make $50,000 a year, I'm going to use the S corporation because I want to avoid the self-employment tax. If I have a W-2 job where I make $200,000 a year, I'm a lot less worried about the self-employment tax because I've already paid it.
Right.
Okay. Now
Right.
maybe I do use an LLC to run my
Mm-hmm.
my rehab business.
Right. Yeah. So basically, Phil, what Ted's saying is everybody has a unique situation there that would be, in order to determine what the best setup would be, you're going to want to have, well, if you'd like to reach out to Ted, you're available, what, at Lanzaro, CPA.com, right?
Right. Yeah. My email is ted@lanzarocpa.com, and I'll spell Lanzaro for you.
Lanzaro
LANZAROCPA.com.
Okay, so it's Ted at LanzaroCPA.com,
Right.
correct?
And my phone number is 203
Yep.
922
Yep.
1742.
1742.
Yeah, and it is. I mean, that's a kind of a decision that you would want to talk to somebody about before you make, because there are other factors to be taken into consideration.
Sure. Yeah. Okay, guys, that was a good question, Phil. Anybody else have anything? Ted, how about this one? This is a question that I have. My son's getting of age now where we're, he's old enough to start doing some chores and making some money. You had talked about in your book about paying your kids to do office work and property maintenance. Is there a limit to what they can be paid and, what's considered reasonable?
Yeah, I mean, look, I've got the same situation. My kids want to work. They want to
Yep.
make money. It's good. It's a good thing.
Yep.
And yeah, look, I mean, I don't think that. I mean, look, they're not going to work 40-hour weeks and stuff like that, right? So if you've got your kid doing some filing, 3-4 hours a week, and you're paying them $10-12 an hour or whatever, look, they can make some money. You're teaching them some work ethic, and you're getting the deductibility, because yes, they will file a tax return for that money, right? But a portion of it is going to be, there's going to be they're going to have a standard deduction also, and a portion of that is going to be offset by the standard deduction. So you may be able to pay them $5,000 worth of income, deduct the $5,000 from your company, and then it's not really taxable to them.
Right.
Because it's getting offset by their standard deduction.
Yep. And you could do that up until what? They're 18?
Well, typically, yeah, you can do it up until they're out of school. Technically,
Okay.
I mean, you're allowed to hire your kids. Let's say they're out of college and they join your company. You could hire them to literally be a full-time employee of your company. There's nothing against that. But I'm just talking about in that scenario. I'm talking about just paying your minor, and they don't even have to be really of age to legally work.
Right.
Like
within your own business.
I pay my 10-year-old daughter filing. She's a really good filer.
Yeah.
And I pay her $10 an hour just to file my paperwork.
Right. So you get the deduction, and I mean, then you can contribute to a college fund or some type of an entity, or even their retirement.
That's exactly right. You could, in theory, set up IRAs for them.
Right.
And all the money goes, they don't even ever see the money. All that goes into their either college plan or IRA.
Yep.
A really good head start.
Yeah. All right. Awesome.
One other thing, I'm going to say one other thing.
Yeah, go ahead, please.
I've been telling people for a long time. If you have young kids, right, a lot of you can do some really good college planning for them by buying them a rental property, right? Buy a rental property, and then let's say you have a new baby, right? Now for 15 years, you're going to get the mortgage pay down, right? You're going to get whatever appreciation. You're going to get cash flow. And yeah, you're going to do a little work. But most people will never, the money you would make doing all of that, most people would never put away. In
a savings account or
account, if you're not going to be able to put that kind of money away, $100 a month.
Right. Yeah. I know it's a much better strategy for sure. All right. Ted, a lot of great information here today. Before we wrap this up, again, guys, if you want to get a copy of Ted's book, The Tax Smart Landlord, you can go to joebarletta.com/tax smart. You can download a digital copy. If you want a paper copy of it, you could send Ted an email. His contact information will be available on that page. If you want to reach out to him for tax strategies or tax advice, he is available at 203-922-1742, and it's Ted at LanzaroCPA.com. Phil had another question here. Is a standard deduction $12K for each kid, so you could pay that without them incurring tax? So is there a standard deduction of up to $12K for each kid?
I really don't right this minute know exactly. I haven't done any personal returns yet, so I haven't seen what the kids' returns do. In theory, that's correct. A single person would have a $12,000
Limit.
standard deduction. I don't know whether or not I don't know whether it gets reduced if
You have more than
they're dependent of another. Like if they're dependent, that amount may be reduced.
Okay. All right. Very cool. Excellent. All right, Ted, wealth of information here today. Thank you very, very much for sharing all this. Again, guys, if you haven't connected with us at the Facebook group, The Art and Science of Real Estate Investing, please reach out to us there or connect with me at joebarletta.com. It was awesome having Ted on call here today. Yeah, no, this was a lot of great information. Be sure to download that book. There's a lot of great strategies in there and tips. You guys could save thousands of dollars potentially on your tax returns this year. It was a great call today, and I hope you guys all have an awesome, awesome weekend. Ted, thanks again so much. Really appreciate it, buddy.
Appreciate it.
All right, we'll talk soon. Thanks again, everybody. We'll see you on the next call.
Okay.